Hi, I'm Robert A. Green, CPA, CEO of Green Trader Tax, and managing member of Green, Neuschwander, and Manning, LLC. Let's talk about Section 475, a powerful election for those eligible for trader tax status. I call it tax loss insurance. Traders eligible for trader tax status are entitled to elect 475 MTM, ordinary gain or loss treatment, versus the default capital gains and loss treatment on securities and or on commodities, 1256 contracts. Section 475 ordinary losses offset all types of income, whereas capital losses only offset capital gains. A net capital loss is limited to $3,000 against other forms of income. The excess is a capital loss carryover to subsequent tax years. If you have a big loss, you want to deduct the entire loss. You don't want to be stuck with a capital loss limitation. We covered that in a prior lesson. Also, Section 475 trades are exempt from another limitation, war sale loss adjustments on securities. That was covered previously. Now, with the new tax law, there's also a benefit on 475 income, the 20% pass-through deduction. Now, the regulations are not fully finalized. They haven't even come out yet as of this publication. They're expected soon. So we have to work out some details, but this is how we see it now. Section 475 ordinary income is likely qualified business income, which is what you need, business income, for the 20% pass-through deduction in the Tax Cuts and Jobs Act starting in 2018. QBI excludes capital gains. So more traders and hedge funds even are considering a 475 election. Now there's another limitation. A trading company is likely a specified service activity where there are limitations. And that means that the taxable income threshold applies. If you make more than the income threshold, you're out of luck. You don't get the deduction. The threshold is $315,000 a year for married filing joint taxable income, or $157,500 for other taxpayers. Plus, there's a phase-out range above that, $100,000 for married filing joint, $50,000 for other taxpayers. Now, there's no self-employment tax on Section 475. So if your local accountant said don't elect it because it will trigger self-employment tax, they're wrong. Section 475 ordinary income is not self-employment income for the self-employment tax, SE tax. TTS, trader tax status traders, they need to form an S corporation with officer compensation, that's earned income, to create the earned income required to unlock health insurance and retirement plan deductions. So if you want those big deductions, health insurance and retirement plans, and you have trader tax status, you need the S corp, and then you have those deductions. You don't necessarily need a 475 election either for that. Now, the Section 475 election procedure is unforgiving. Existing taxpayers file the election with the IRS by the due date, and if you're a new taxpayer, like a new entity, you can elect it internally within 75 days of inception. So let's first talk about the election statement for existing taxpayers. They need to attach the 2018 475 election statement. They needed to do this. They had to attach it to their 2017 federal tax return or extension filed by the original due date, which was April 17, 2018 for individuals and March 15, 2018 for existing S-corps and partnerships. So if you filed 2017 tax returns, those were your due dates. And if you're first learning about it now after April 17th as an individual 2018, it's too late. But there are some other things you can do. Now, for a 475 election statement, you can find that as well as more information about it in Green's 2018 Trader Tax Guide. And you're going to elect it one time. Once it's in place, it remains in effect as long as a trader qualifies for TTS until and unless you revoke it, which you can do as well. Now, for the external election, there is a second step, the Form 3115 filing. That's a change of accounting method. For existing taxpayer 475 elections, the election statement is just the first part of the election process and the most critical. That's where the IRS sees that you're not trying to use undue hindsight, that you're electing it early in the year as the procedure requires. TTS traders also have to file the second step, a timely 2018 Form 3115 with their 2018 tax return in 2019 with a duplicate copy to the IRS National Office and file the 3115 by the extended deadline. It's a pretty complicated form. It's not that hard to fill out, but you need to know all the various code sections and include a 481A adjustment if one of those applies to you, and read about that in the guide. Now, there is a new taxpayer exception. For a new taxpayer like a new partnership or a new S corporation, you can place the 475 signed election resolution in your books and records within 75 days of inception. You don't have a prior tax return that you're filing with the IRS, so there's no way to attach an election statement to a prior return. So this is what you do later in the year, is if you missed the election earlier, you can form an entity to elect it internally. Now, what's nice about the new taxpayer exception is that a Form 3115 is not needed for internal elections, since the trader is adopting an accounting method from inception rather than changing accounting method like existing taxpayers. If you missed the election deadline, consider a new entity with an internal election for the balance of the tax year. Securities versus 1256 contracts. Remember, you can elect 475 on just securities or just commodities or both. Now, mark-to-market accounting, what that means is it requires the reporting of unrealized gains and losses on open TTS securities positions, not your segregated investment positions. So you're imputing a sale at year-end based on year-end prices and then imputing a purchase at the start of the next year. Section 475 allows the selection of securities and or commodities, which really means 1256 contracts. Most traders prefer 475 on securities only, so they retain lower 60/40 capital gains tax rates on 1256 contracts. Remember, with 1256, 60% of it is a long-term capital gain, even on a day trade. And they're taxed at the lower tax rates of 0%, 15%, and 20%, the so-called capital gains rates. And the other 40% is a short-term capital gain taxed at ordinary rates, which go up to 37%. The highest 60/40 rate is 26.8%. So you could be trading securities and 1256 contracts and elect 475 on securities only and retain the lower 60/40 rates on 1256 contracts. One of the biggest benefits of 475, if you happen to have a large loss, which many traders do from time to time, it's net operating losses, NOLs. Section 475 losses contribute to NOLs. Capital losses do not. Starting in 2018, the law has changed under the Tax Act. NOLs are carried forward indefinitely, and they are limited to 80% of taxable income in the subsequent year. 2018 NOLs may not be carried back except for farmers. That's unfortunate. The prior law was much better. You could carry back a 2017 NOL 2 tax years and get immediate tax refunds. That was great for traders to replenish their capital accounts. Now they have to wait for an NOL carry forward. Now, they may have other income to absorb the losses, but the new tax law also limits excess business losses over $500,000 married, $250,000 other taxpayers. If you exceed that excess business loss, it's carried forward as part of an NOL. So here's an example. You have wages of $500,000 and your spouse has business income of $400,000. You have $900,000. You have a $600,000 trading loss. You're limited to $500,000 against your other income, so you get an immediate benefit versus having a capital loss limitation of $3,000. You have an excess business loss of $500,000, and then carry over the $100,000 to next year as an NOL, where you're not going to be limited to 80% of income because you have so much income, and you won't be able to have an NOL carryback if you didn't have much income in the current year. So the law has changed, but still 475 and the NOL rules and the excess business loss rules are very generous and great for traders and worthwhile doing. Now you can segregate your investment positions to still defer capital gains and not have MTM applied. You're entitled to contemporaneously segregate investment positions that aren't subject to 475 MTM treatment, meaning at year end. So you can defer unrealized gains on adequately segregated investments. Now do the segregation in the best way possible. It's better to ring fence the TTS, trader tax status trading, with a 475 election in the entity and keep the investments on the individual level. Now, if you're doing portfolio margining, that's more difficult to do. So be very careful to segregate so you don't give the IRS opportunity to play havoc on those benefits. If you do it right, with 475, you can have the best of all worlds. A trader can have ordinary tax losses or income for the pass-through deduction on the business trading with the 475 election. You can retain the lower 60/40 capital gains on the 1256 contracts and have that loss carryback election. And you can defer lower long-term capital gains tax rates on segregated investment positions. The decision-making on this is crucial. If you have capital loss carryovers or significant unrealized capital losses on segregated investment positions, you know you have tax baggage. You're in a hole. You have a capital loss hole. So if you prematurely elect 475, which is a gamble, you'll be sorry because the mark-to-market is ordinary trading gains, and you're hunting for a capital gains income ladder to climb out of that capital loss hole. But you need a 475 election so you don't dig a bigger hole. I walk you through this decision making in my tax guide with various examples. So if you're starting off the year and you have in Q1 large trading losses, you want to go ahead and elect 475, and then you can form an entity for a do-over to get back to capital gains treatment. So it may be beneficial to elect 475 and then form a new entity where you have that do-over. Or you could revoke 475 in the next year. So every time you have a decision-making opportunity for 475 or not, or revocation, you need to make the right decision. You might even elect it on futures to have a large ordinary loss and then revoke that part of the election in the following year. If you want tax loss insurance, exemption from capital loss limitations and wash sale loss deferrals, and a chance for the 20% pass-through deduction on qualified business income, then consider a timely Section 475 election. Consider capital loss carryovers and other nuances before you make the election. Consult a trader tax expert, as Section 475 requires eligibility for trader tax status. That concludes the Trader Tax 101 course. I hope you understand which type of trader you are and associated tax planning opportunities. Remember these key takeaways. If you qualify for trader tax status, use business expense treatment, consider a 475 election by the deadline, and do your best to avoid tax pitfalls from wash sale losses, the capital loss limitation, and suspended investment expenses. Thanks for taking part in this course, and look out for the final quiz to test your knowledge.